This week, the Reserve Bank of Australia Board kept the cash rate on hold at 4.35%, as was widely expected. Now, while inflation is declining broadly on the track that the RBA expected, it remains concerned that underlying inflation is still well above the 2 to 3% target range. Total headline inflation is, of course, below 3% at the moment, but this is because of the effect of electricity rebates. In order to assess the underlying momentum in inflation, the RBA is looking at measures like trimmed mean inflation, which are still above target. They're also concerned that these measures have not been declining that quickly recently. That said, their forecasts have been shaved down a little bit, and we are getting a clearer picture of that decline in inflation sustainably into the band and hitting 2.5% by the end of 2026. This is what the RBA Board is hoping to achieve, and it seems likely that as long as things turn out as they expect, that will be what they're achieving. There are a number of changes in the RBA's forecast outlook, including that small revision downwards in trimmed mean inflation right through the next few years. They also revised down their outlook for wages growth a little. In addition, they revised down their view of consumption and highlighted that there were downside risks, particularly in the near term, because it seems that the Stage 3 tax cuts haven't boosted household spending as much as was previously assumed. This is the same message that we've been seeing in our own banking data using the Westpac DataX consumer panel. On the other hand, the RBA has become more alert to stronger outcomes in the labour market. And in their statement on monetary policy, they characterised the labour market as still being tighter than would be consistent with full employment. They're worried about weak productivity growth potentially not picking up, and they highlighted that employment growth remains strong and that some of the indicators they look at to assess labour market conditions have stopped easing as they were in recent quarters. These include some of the business survey measures as well as average hours worked. So it remains to be seen whether the economy actually continues to ease at the pace that the RBA is expecting and hoping for. And one of the things that the RBA has been highlighting is that the labour market in Australia is a bit tighter than in some other countries. We would observe, though, that most of our peer economies not only tightened more than the RBA did, but also inflation started increasing and peaked earlier because many of those economies were earlier to open up after the pandemic. And so they're later in the disinflation journey than Australia is. So it's no surprise that they're also further along in the easing of the labour market. It's also no surprise that they're further along in the easing of the labour market because achieving a smaller easing in the labour market was the RBA's explicit strategy when it set out to increase rates by less than some of its peer economies. So this observation is exactly in line with what the RBA was seeking to achieve. So while there were some elements of the RBA's rates decision and their statement on monetary policy and forecasts that were a little more hawkish than our own view of the data, there wasn't really anything in that communication or in the Governor's press conference that would lead us to shift our view about the rates outlook. We still see the disinflation as being on track. As the RBA gains more confidence that that disinflation is on track, we see them as being in a position to start cutting rates, and we still think the most likely date that that will start is February. We don't see a rate cut in the last meeting of the year. There's just not enough time for things to change for the RBA to change its mind in 6 weeks' time. But we do think that most likely in February, they will have seen enough to be confident that inflation is declining and will be sustainably in the target band on the trajectory that it's currently forecasting.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.